So if you want to find underpriced equities, go to stonealpha.com and click on equities here at the top. That's going to bring up a table like this. What you're going to have here is a range bar where when this red dot is near the top, it shows you that the price is trading at quite a high multiple of its earnings. So for example, if a stock's at 100 and it's earning $50, that means it's trading at 2 times its earnings. Over here, you could see that it's trading at 48 times its earnings. So people are willing to pay this. That's a very important thing you need to understand, that people are willing to pay this, investors are willing to pay this, and that's why the stock is trading up here. They're willing to wait 48 years for them to get their money back on their investment. So we don't want to be paying that just yet. We want something slightly cheaper. So you filter it by the PE range. You scroll down to something that comes up a bit cheaper, something trading a little bit below its average. So we could see companies like this. I don't know what these companies are or what they do, but we could just go ahead and click in one of these cheap ones. We ideally also want to make sure that when we go here to the top, that their forward PE earnings are the forward PE ratio is positive as well. So we'll look at something here that has something positive, relatively cheap. What have we got here? For example, we have Xylem. I don't know what this company is or what they do, but we'll go ahead and take a look. We can see here that they're trading at $108. This should be a synopsis of what they actually do here. I need to fix that bug. Now let's look at their range. We can see over the last 3 years, they've traded between 21 times earnings as far high as 38. So it shows people are willing to pay 38 times its earnings. You could see here that the stock has been declining recently, so we need to investigate a little bit more as to why. It could be something to do with the declining earnings here. If we go to the annual view, hey, that's not so much a huge fall. So that's looking relatively positive. So we do need to see free cash flow yield. We can't see that. So that's a little bit of a concern. They might have to start raising cash here, but there is insufficient history. I will be pulling that in. And then if we go here, 38 times earnings, let's model that up to 38 times where people have been willing to pay in the past. Let's go to 34 times, slightly less. We can see that takes us to a price of 148%. So about 30, there's about 30 to 40% in this stock, which is quite a decent potential. Now, please keep in mind that there are other methodologies that we'll use. It's not just the PE ratio. There's other things that will come together to make one final valuation.